Students, today we are going to learn classification of accounts as per the modern approach. Accounts are divided into 5 types. First one is the asset account. Assets are the possessions of the business. Assets are the things owned by the businessman. So here the examples are given. You can see machinery account, building account are all tangible assets which you can see, touch and feel. Goodwill account is the intangible asset you cannot see and touch, but then it has the monetary value. It is the reputation of the business. So goodwill is considered as one of the assets. Then furniture account, though they have given only 4 examples, there are number of assets. Something that is receivable by the business. I'll repeat again, something that is receivable by the business is also considered as an asset. Second type is the liabilities account. Liability means the money or funds owed by the businessman to the third party. This is the amount payable by the businessman to the third party. Here first they have given the creditors account. These are the suppliers who supply the goods and commodities and the services to the business on credit basis. So the businessman has to pay them in the future. So creditors are the suppliers. Then the bank overdraft account. This is the facility given to the current account holder. Normally the businessmen, they open the current account where the facility is given to overdraw the account. It means suppose the businessman has only rupees 10,000 in his account, but then he is in need of rupees 15,000. So he can withdraw rupees 15,000 from the current account even though he has the balance of rupees 10,000 only. So this excess 5,000 is known as the bank overdraft, which will be paid by the businessman to the bank in the future. So this is the liability. Then the bank loan account, the loan borrowed by the businessman from the bank. Then the outstanding expenses. Meaning of outstanding expenses is these expenses are due for the current accounting period, but they are not paid by the businessman. For example, salary is paid to the labor or to the employee for 12 months, but due to financial crisis, the owner of the business has paid only 8 months salary to the employees. So the 4 months salary which is due but not paid will be known as outstanding expenditure. So this is also amount to be payable in the future. So you have to remember that liabilities account is nothing but the amount to be payable in the future by the businessman. Then next is the capital account. You all know that capital is the amount invested by the businessman in the business. In order to start the business, to set up the businessman has to buy the fixed assets. Sometimes he has to buy the raw material. He has to buy the premises. So all these expenses are to be incurred, and for that capital is required. So capital account is the amount invested in the business. Then the revenues and gains. Here they have given the examples of the revenues and gains. Something which is received by the business. Commission received, dividend received, rent received, interest received, discount received. Something which is received by the business is known as revenue and gains. Then expenses and losses. The businessman has to bear several expenses. Sometimes he has to bear the loss also. So all these will come under this heading: wages account, salary account, then printing and stationery account, rent account. So something which is paid by the businessman will be recorded under the heading of expenses and losses. Here loss by fire, loss by theft will also be recorded under this last heading. So this is the classification of accounts as per the modern approach. Next page we are going to learn the fundamental rules as per the modern approach. First rule is increase in asset is debited. Normally asset is the real account which you can see and touch. So whenever the value of the asset increases, we bring in the asset in the business. So that is why increase in asset is debited. When the asset goes out of the business or when the value of the asset decreases, then it is credited. Next, increase in expenses and losses is debited. Now expenses and losses is the nominal account and we have learnt debit expenses and losses. So normally all the expenses and losses are recorded on the debit side of the profit and loss account. So we have to follow this rule. Increase in expenses and losses is debited while decrease in expenses and losses is credited. Next, for recording changes in liabilities, capital, revenues and gains. Increase in liability is credited. You all know that liability is the amount to be payable in the future. So all the liabilities, they have the credit balance. So further increase in liability is credited while decrease in the liability is debited. Then increase in the capital is credited because capital is the personal account, and whenever the capital amount increases we have to credit because the businessman is the giver of the capital. Decrease in capital is debited. If the amount is taken from the business or goods are taken from the business for personal use, then we have to debit the drawings account. Though capital and drawings are two different accounts, but capital decreases when the cash or goods are taken from the business for personal use. Then increase in revenue and gains is credited. As per the nominal account, credit incomes and gains. So increase in revenue and gains is credited and decrease in revenue and gains is debited. So these are the rules you can follow while passing the journal entry as per the modern approach, or else you can follow the traditional approach where the accounts are classified into three categories, that is the real account, personal account and nominal account. And the rule for the real account is debit what comes in, credit what goes out. So under real account we have to classify the things which we can see and touch. Personal account includes the natural person's account or the artificial person's account. So natural persons like my account, your account will be recorded under personal account, and artificial person's account is the company account, bank account, school or college account will be recorded under artificial person's account. Then nominal account, expenses and losses are debited and incomes and gains are credited. So these are the rules to be followed as per the traditional approach, and these rules which are given here, all these rules are followed as per the modern approach. Any one approach you can follow while passing the journal entries. Next, We are going to learn this table now, analysis of transactions by applying rules of debit and credit as per the modern approach. Now the first transaction given here is Sanjay commenced business with cash of rupees 70,000. Two aspects or effects of this transaction are: when Sanjay set up the business, that time he invests cash of rupees 70,000. So cash comes in the business. Sanjay is the proprietor, owner. He gives the cash to the business, so he is a giver. Which two accounts are involved in this transaction? First is the cash account and second is the capital account. Now cash is the asset account. Now here, as per the rules, we have seen that increase in asset is debited. So we have to follow this rule. Here cash comes in the business, so there is an increase in asset, so that is why cash account is debited. Now capital account, there is an increase in the capital. So as per the rule, we have seen here that increase in capital is credited. Here you can see in the second point, increase in capital is credited. So that is why here account to be credited is capital account. Next, rent paid cash of rupees 5,000 to Amol. Now here you can see that three accounts are involved: rent, that is the expenditure account; cash, that is the real account; then Amol is the personal account. Three accounts are involved. But whenever any expenditure account is involved, first you have to consider the expenditure account and real account, and you have to ignore the personal account. So that is why we are not going to consider Amol's account here. So the remaining two accounts which are involved here are rent and cash. Now first we will see two effects of the transaction. First effect is what? Rent is an expenditure. Rent paid, something which is paid, is an expenditure. So rent is an expenditure. Now second account which is involved is cash. Cash goes out of the business. So two accounts are involved. First is the rent account, second is the cash account. Now you all know that rent is an expenditure. So here the rules are given as per the modern approach. The rules are given. Second rule, here you can see increase in expenses and losses is debited. When rent is paid, the expenditure increases. So here you can see increase in expense. So that is why rent account is debited. Now cash is the asset account. Now cash goes out of the business. When cash goes out of the business, there is decrease in asset. And as per the rule, you can see here in the first rule, here you can see decrease in asset is credited. So that is why we have to credit cash account. Next, withdrew cash from bank rupees 10,000 for office use. This is the transaction. Cash of rupees 10,000 is withdrawn from the bank. So cash comes in the business. When cash is withdrawn from the bank, cash comes in the business. That is the first effect or aspect of the transaction. Okay, who is the giver? Second account which is involved here is the bank. Since the cash is withdrawn from the bank, bank is the giver. Bank gives cash to the businessman. So bank is the giver. That is the second effect. So two accounts which are involved in this transaction are: first is the cash account and second is the bank account. That is our bank balance. Here you can consider bank balance as an asset. Okay. So two accounts which are involved here are asset account and asset account. Now here, increase in asset, cash comes in the business, so our asset increases, that is why cash account is debited. Now bank is the giver, and when bank gives us the money, our bank balance decreases. Normally the bank gives money from our bank balance, which earlier we have deposited in the bank. Bank balance is the cash which we have deposited earlier. So that is also our asset. Now when we withdraw cash from the bank, our bank balance decreases. So there is decrease in asset. So that is why bank account is credited. Now see, the modern approach is different. If we go to see the traditional approach, bank account can be the personal account and bank is the giver. As per the traditional approach, bank is the personal account, bank is the giver. So we have to credit bank account. But as per the modern approach, here we are considering bank as our bank balance. So it is our asset. So there is decrease in asset. So bank account is credited. Next, paid wife's mobile bill rupees 4,200. Now here wife's mobile bill is the personal expenditure. You can see that wife's mobile bill is not the business expenditure. It is the personal expenditure. So amount of rupees 4,200 is used from the business to pay some kind of personal expenditure. Whenever any kind of amount is used for the personal use, it is called drawings. So here drawing is the receiver of the benefit, and as per the modern approach, drawing account is considered as capital account. You have to remember that drawing account as per the traditional approach is considered as the personal account, but as per the modern approach, drawings account is classified under the category of the capital account. Now as per the rule, if the capital decreases, we have to debit that account. You can go through the rules again here. See, second rule, decrease in capital is debited. Now drawings comes under the capital account, so decrease in capital is debited, so that is why we have to debit drawings account. Now when wife's mobile bill is paid, the second account which is involved is cash account, and cash goes out of the business, and cash account is the asset account, and decrease in asset is credited. Here you can see the rules. It is given here. Increase in asset is debited while decrease in asset is credited. Here cash goes out of the business, so there is decrease in asset, so cash account is credited. Next, purchase goods from Sunil for rupees 13,000. Two effects of the transaction. Purchase is an expenditure and Sunil is the giver. Now students, here you can see that here it is not mentioned whether cash is paid immediately or not. Here, since they have not mentioned anything about the cash, we have to consider this as the credit transaction. In credit transaction, cash is not involved. So the two aspects of the transaction are, first is purchases is an expense, and second is Sunil. Sunil is the giver. He is the creditor. Now two accounts which are involved in this transaction are purchases account and Sunil's account. Sunil is a creditor. Category: purchases account is the expenditure account and creditors account comes under the category of the liability. Here you can see second is the liabilities account and creditors account is recorded under the second category of the liability. Since Sunil has supplied goods on credit basis, he is considered as the creditor and his account is classified under the category of the liabilities. So we have to follow the rule of the liability. Increase in liability is credited. This is the rule you can see here. Increase in liabilities is credited. So what happens in the table, that Sunil's account is the liability and there is an increase in the liability of the business. So Sunil's account is credited. While purchases is an expenditure and expenditure has increased. So increase in expenditure is debited. So purchase account is debited here. Next, received commission rupees 4,500. Two aspects of the transaction are cash comes in the business. When commission is received, cash comes in the business. And commission received is the income for the business. So two accounts which are involved in this are cash account and then the commission account. Cash account comes under the category of the asset account. And as per the chart, we will check the chart now. As per the chart, commission received comes under the category of revenues and gains. Here you can see commission received account is written here. Now we will check the rules. The rules here, third rule, increase in revenue and gains is credited. So here in the table, instead of writing here commission account, this is the printing error, they should write income or gain account, revenue or gain account. Here they should write. So this is the printing error. So the category is what? Revenue or gain account. And the rule applied is increase in asset is debited. Cash comes in the business, so our asset increases. So cash account is to be debited. And the rule for the revenue and gain is increase in revenue and gain is credited. So the commission account is credited here.